So welcome everyone. Thank you for joining us in this first session after lunch. Before we kick it off, I just wanted to thank you all for attending and also thank the FII for giving us this opportunity to talk about a topic which I am very passionate about. So this topic is challenges and opportunities in emerging markets for sovereign wealth funds. So it really falls into two separate pieces. There's the investor piece, so what trends are we seeing in the world of sovereign wealth? And then there's the investee piece. Where is the capital flowing? Where are we seeing the greatest opportunities? Now, for those of you who were in the opening panel yesterday, Khaldoon Al-Mubarak, who's the CEO of Mubadala, echoed that there's a real strength through partnerships. And this was followed up by RDIF of Russia and the Public Investment Fund of Saudi Arabia. And what has been really interesting when you study the history of sovereign wealth is their response to increased protectionism in the West has been a very fascinating one. So many sovereign wealth funds in emerging markets are forming joint venture partnerships, which essentially act as bilateral agreements between the countries. So yesterday we had Russia, we had Saudi Arabia, and we had Abu Dhabi. They all between them have formed joint venture partnerships. Saudi Arabia, Russia, Saudi Arabia, Abu Dhabi, China, China, Russia. And there's this mix which has been so interesting to see when you're within the investment community. Why do we even care? Why does that matter? Secondly, we'll be looking at the emerging markets themselves, and we appreciate that emerging markets is not a homogenous group of countries. So because of the strength of the experience and the depth of knowledge of the people on my panel, we'll be focusing on India, China, Russia, and Saudi Arabia. So I thank my panelists for joining us today as well. On the panel today, we have Michael Madwell, who's the founder and president of the Sovereign Wealth Fund Institute. We have Eric Burgesson, who's the president at Wasatch Advisors. And we have Jim Breyer, who's also president and founder of Bayer Associates. So just to kick things off for discussion today, I thought it would just be good to give the audience a bit of background about what your perspective is to this conversation.
Sure. My perspective that I'm going to share with you today is a perspective on the overall market trends in the sovereign wealth fund pension world. As we know, sovereign wealth funds are above $8 trillion in assets. When I co-founded the Sovereign Wealth Fund Institute back in 2008, sovereign wealth funds made up just $4 trillion in assets, so a double. And when that happened back in 2008, it was a global financial crisis, and sovereign wealth funds were heavily invested in developed markets, the United States, Europe, and elsewhere, and a lot of that money was externally managed. Today, things are different. Sovereign wealth funds are getting smart. They are partnering with leading institutions, doing more direct deals. They are building their internal staff and teams, and definitely taking a deeper look into these emerging markets. Now, everyone here has a smartphone. In that smartphone, there's apps. Uber, Square by Payments, Payments by Square, I mean, Didi, all of these apps receive sovereign wealth fund money. When you flew in here on some of these airplanes, they might have been leased aircraft. Well, some of those companies are owned by sovereign funds and very large pensions. So the sun never sets on sovereign wealth. I'm going to pass off to Eric and Eric's introduction.
Oh, thank you very much. Well, my perspective I bring today is really that of an investor, both as representing a firm that invests extensively in emerging markets, but also one that manages money for both sovereign wealth funds as well as institutional investors around the world. Emerging markets, really from an equity perspective, the main feedback I'm getting from investors has been, when is it going to work? Emerging markets has really struggled the last number of years. One of my clients showed me their returns, and their emerging market equities portfolio over the last number of years has literally been their worst performing asset class, actually doing worse than most of their fixed income asset classes. And I think there's a very straightforward case for emerging markets, the rising middle class, the greater growth rates, and I think there's a bit of a question of when will that start to play out for investors. I have some views on that, and we feel like it right now actually is a very opportune time to be investing in emerging markets, but that's the perspective I'll bring to the panel today.
Jim Breyer, it's wonderful to be part of this panel. I'm a technology venture capitalist. I believe over the next 10 years for technology venture capitalists to continue to generate important, significant returns, we cannot be insular. There's a saying in Silicon Valley where I live that if it's not within 15 minutes, we won't invest. That's about 10 years out of date. And so my belief as a technology venture capitalist, private equity investor, forming deep partnerships, whether it's with my partners at IDG China, whether it's with sovereign wealth funds, it's all about long-term scalable strategic partnerships so that as we sit back 10 years from now, we think about the 20 most important market capitalizations in the world. I think 18 of them or so will be technology-based, and I think that over half will be from emerging markets. That's my investment thesis.
Excellent. I'd like to pick up on something you just mentioned, which has been reiterated throughout this conference, which is that of strategic partnerships. Now, I know, Mike, you've been following this very closely in the sovereign wealth fund world and the partnerships that we're seeing being formed. Can you maybe talk a bit more about whether that's, politically driven, or is that an investment thesis? What are some of the underlying rationales?
Initially, it was commercially driven. Deal flow is very important for many of these sovereign wealth funds as they go direct. And so that was the initial focus. And so in 2008-9, the Russia Direct Investment Fund started working with other countries, whether it's in Italy, France, Japan, even at one time the United States. And now we're seeing the acceleration happen with the PIF working with Russia. You see Mubadala working with the Russian Direct Investment Fund. We're also seeing some of the GCC funds work together. And it's not just government to government, it's also government to private. So, for example, the China Investment Corporation recently inked a cooperation fund with Goldman Sachs. I just heard recently that they're also talking, the CIC is talking to Nomura, a Japanese financial institution. So partnerships align. They help people get access to these niche deals, whether it's going to be in farmland, agriculture, infrastructure. Jim was talking about healthcare, and having partners is really important in that. That's and also that kind of leads into the transparency. Is how transparent are your partners, and where those crosses align.
Yeah, I think it's, especially when you're looking at emerging markets, transparency is always an issue, or corporate governance comes up time and time again. I know that, Eric, you've done quite a bit in China, and you've spoken about that the government interference can really change an investment mandate or strategy. Can you talk a bit more about the role that government has to play?
Sure. It's one of the great challenges of emerging market investing is you can do really well in understanding the company. You can see the economic case for a company, but that entire economic case or return opportunity can be unwound by macro events. And I think that's one of the things that's been affecting emerging markets the last few years. There's been a number of very large macro headwinds. And so one of the challenges as an investor, I think it's important to have a framework for evaluating a country, whether that be from a financial stability standpoint, the stability of the currency, but more importantly, understanding the regulatory or governmental structure in a given country can be very important to understanding whether you should actually allocate capital there. I know for us in the past, one of the most difficult countries has been China because it's somewhat opaque. It's very difficult to understand where the government might want to, impact businesses. We've had instances where we had very, wonderful companies. In one particular instance, it was a biotechnology company who announced an acquisition of an asset manager. And when we pressed on that company over and over, trying to understand what was the rationale for this, departure from your strategy, when you finally got to the end of the day, the government had basically imposed upon them and said they needed to acquire this asset manager, and it was really negative for their business. Those are things that are very hard to handicap, but you do your very best at the front end. Today I think one of the examples, when we run and we look at emerging market companies and score them and look at them from a quality perspective, one of the very highest rated companies that we have in the entire universe of emerging markets happens to be in Turkey. But at this point in time, given the political situation in Turkey, the economic backdrop, it is basically a country that we will not invest in, because it just really does not have a background where we feel comfortable that despite the fundamentals of this company are going to actually be overwhelmed by the macro and the governmental infrastructure. So ultimately, evaluation of government is very important to your ultimate returns in investments in emerging markets.
I want to come back to one of the points that you made about transparency, but Jim, I was just wondering if you had similar experiences with your dealings in China, and I know that you invest there quite heavily.
Well, I've been investing in China since 2002, and today the investment thesis is we're in the first or second inning of artificial intelligence. It's a significant race, depending on the segment, between the United States and China. And again, the vast majority of the breakthrough artificial intelligence companies and technologies will emanate from top university campuses, whether it's Harvard, MIT, Stanford, Tsinghua. It will be a combination of students, postdocs, professors, and then at the same time, there has to be an understanding of how to build long-term global technologies that scale. And without sovereign wealth funds and without large partners, even the best of the best, whether it's Palo Alto, California, Cambridge, Massachusetts, or Beijing, don't necessarily have the humility or the understanding of how to scale dramatically in a world where we have to all understand that scaling dramatically, globally, is fundamentally important. The competition for the best AI engineers at Tsinghua is very similar to the competition for the very best AI engineers at Stanford and Berkeley or MIT and Harvard. And that's why there has to be a global perspective and why we have to take global perspectives in many of these most important new technology areas.
There was a very, speaking of the relationship between China and the US, the foreign minister of China famously described the relationship as one of simultaneous friction and cooperation. And I think that's true of the US relationships with a lot of these countries now. There's the competition for the technology, but they know that they need to work alongside it in many cases as well.
It's very true. I like to say it's exactly that same dynamic between Alphabet and Amazon and Apple and Facebook. Everybody's competing for scarcity of talent. And so we all have to keep getting better and think about differential edges. And part of that is how to scale globally, internationally, and have the opportunity to think that through in ways that perhaps we didn't think that way before as much as we should.
And what do you think, from all three of you, the positive impacts that sovereign wealth capital could bring to this competition? You know, there's been a lot of pushback, for example, on the SoftBank Vision Fund and maybe what it's doing in Silicon Valley, but then you're seeing some knock-on effects where that long-term patient capital is really having a positive impact.
I think sovereign wealth funds bring a stable investor, whereas venture capital funds, their life cycle, so they have to reinvest that capital and kick it out. So firms can wait to IPO longer. They don't have to quickly hit the markets and provide a return for their investors. So that's why you saw Uber, PIF invested in $3.5 billion at a $60 billion valuation. Now it's $120 billion valuation, as Yasir mentioned yesterday. So they can take their time and wait and play things out. And also it's creating a lot of competition. At the same time, sometimes I wonder, how much capital is actually needed to fund some of these startups? Because of all this technology, you don't need a lot of money to run some of these operations. But for biotech and healthcare, there's probably a lot more to that as well. So.
Yeah, I would reiterate the stability of a sovereign wealth fund and their long-term horizon is one of the benefits they have. One of our clients is a Middle Eastern sovereign wealth fund, and they, you can tell that they have a 10-plus year horizon in the asset class they're choosing to invest in. The asset class we're managing for them is in public equity space, which is an area that you typically find investors, maybe a 3 to 5 year horizon is the most they're going to give. And This particular investor, you can tell they've made a secular investment in a particular geography, in India in specific, and it's something that they have the benefit of being able to have that long-term perspective. I think ultimately pays to their advantage in terms of getting, garnering returns.
It's well said. It's the combination of a long-term perspective, and I was in New York last week meeting with some very talented hedge fund managers, and I asked them about long-term, and they said they were very long-term hedge fund managers. 12 months to 24 months was their long-term perspective. In venture capital, particularly in areas like artificial intelligence, we have to take a 5 to 7 to 10 year view. I was fortunate to invest in Facebook in 2005 at 5 cents a share. Even the best of the best companies take 7 to 10 years to mature, to scale, and that's only going to continue because some of these technologies, while they might not be capital intensive, it takes time and the talent for the best AI, computer science, machine learning, biotechnology, bioinformatics scientists is more expensive than ever before. It's like an English Premier League bidding war, and that's not going to change.
And you speak about the human capital side. I'd like to focus on that in emerging markets as well. We're actually now seeing talent being exported, emerging markets. Yesterday, Kirill from RDIF spoke about the Alibaba and Russia relationship. Maybe we can talk more about the technology transfer of human capital as well.
Technology transfer, sometimes it can be a sensitive issue. Sometimes it could be an issue where people work together. But yes, there was a deal with Alibaba and the Russian Direct Investment Fund. As we know, we had a September survey, our global asset owner survey, where we poll only asset owners, sovereign funds, endowments, central banks, pension funds, and we ask them, what is the biggest tail risk you see right now? And it's geopolitical risk. And this is really on the minds. A few quarters ago was a stock market bubble, but the geopolitical risk is very serious. And what we're seeing, I'm going to go back to that technology transfer, is that there's a bifurcation of the internet. There's the China internet world, and there's the U.S. internet world. So, for example, there's Uber, Didi, WeWork. There's a Chinese equivalent to that, and so that's why the issues of technology transfer that's why you need these bilateral funds to make sure that those two governments are on the same page for this. But there's a battle going on for the dominance of where the next fintech play is going to be, or where the next social media network's going to be from. So.
Yeah, fintech's an interesting play in emerging markets. I know, Eric, you're very passionate about this space in India. You travel there regularly. What have you seen going on there?
Well, one of the beauties about emerging markets in some respects is they don't have some of the similar infrastructure in areas that developed markets have to overcome or maybe have to change. And India in particular, when you look for secular long-term opportunities where you really have very few items that you can see are going to unseat the long-term investment thesis, the impact of financial services and really credit into a very under-penetrated market in India is unlike what we see really in anywhere else in the world. And it's supported in some government reforms, coming back to the government and the important impact the government can have on its people and its investment environment. In India, one of the things that they've implemented over the last number of years is called the Aadhaar card. It's basically a biometric identity system, and it's one of the fastest growth opportunities of ever getting to 1 billion participants, faster than Google, faster than Facebook. And it basically, finding rural India all the way through the urban areas and providing an identity has enabled people who previously had not ever been able to have a bank account to immediately open a bank account. And if you listen to the Prime Minister of Pakistan yesterday, he was quite passionate about the negative impacts of corruption in emerging markets. So that was one of the major departures between developed markets and emerging markets was corruption. Well, if you trace back to this Aadhaar card, being able to provide something very simple like a bank account, the access to credit, that allows much of, in the past in India, over 90% of the social welfare that was to be distributed to the individual Indians 90% of it was lost before it got to the actual end of the river, so to speak, the end of the irrigation row. Because of this impact in technology, in fintech, you now have the ability for that to come directly to the end participants. And you can imagine the type of growth opportunity that provides in the future. Groups of people who've never had the opportunity for access to finance effectively are going to have that going forward. And so this is an area that if you're looking for the next 20 years, this is not exotic banking. This is basic, fundamental banking that really has a 20-plus year growth trajectory.
And a large population of which it can impact
Absolutely.
so quickly as well. Yeah. And just coming back to the corruption point, we've actually had a number of stories recently that have not done the emerging markets any favors. We obviously had the 1MDB scandal in Malaysia. We've also had the downfall of a very public, one of the sort of darlings of the Middle East, which was Abraj, the private equity business there, which defaulted on about $1 billion of loans. What impact does this have on investors, and how do you see that, investors can work with governments to make it stronger going forward?
I think events like the Abraj Group or 1MDB are major setbacks for investor confidence. Everyone needs to relook at their operational due diligence, reference checks, make sure that, double check the financials, conduct independent audits. And unfortunately, it really benefits the incumbent managers, the large firms of the world. And I'm always trying to, help identify emerging managers because that's where a lot of the alpha is typically generated. And so, this is a major setback, but the best thing that the industry can do is to continue to promote transparency principles. We have a transparency index. It's more on the sovereign wealth fund side of things. And, Rachel has a pretty good story on that one over a time at Mubadala. Rachel, you want to share the story?
Sure, yes. When I actually started at Mubadala about 10 years ago, and it was a very interesting time to move to the Middle East. I think the only time that we were seen as a transparent business partner was when we were being compared to Russia. So, we were quite low down in the pecking order. And Khaldun at the time said it is very, very important for us to be seen as a transparent entity because we know that will help us get, a better caliber of partners. So I went off to see how we could best go about doing this. I Googled, how do you become a transparent sovereign wealth fund? And your index actually came up. So we were the first sovereign wealth fund, as Khaldun mentioned yesterday, to be rated a 10. And it really did have an impact on finding these business partners, especially in the US, where having a good, credible track record and attention to transparency is so important. So I think we really appreciated the importance that that could bring. But I know it's sort of that bifurcation as well, or differentiation between the public and the private markets. It's much easier to get information in the public markets, but many of the sovereign wealth fund deals in emerging markets are private. So it's even harder to get, exact information. And I don't know how you found it in China, because you're doing a lot in the VC space there. So it's quite a thorough due diligence process, I imagine.
Well, a couple lessons. We in Silicon Valley, I would say from a general standpoint, clearly did not invest early enough in compliance and transparency. And in many cases, even the top Silicon Valley companies are now paying the price. And so I've learned many things as an investor. There's a lot of humility. But I'm doing two things a little differently in terms of advising many of the technology startups, both in the US and China. Number one, invest earlier in the compliance functions and make that strategic. And then the second, add diversity from the beginning. Hire more women, add the diversity on the ground floor, because so much of the best talent, so many of the best decisions I've made helping to hire Sheryl Sandberg and other female leaders has made a profound difference in company cultures and how they respond, whether it's Silicon Valley, Cambridge, Massachusetts, or Beijing again. Diversity early on, compliance early on, as we try to build the future standalone competitors to today's Amazons. Those are characteristics that I'm particularly focused on in many of the new, somewhat crazy technologies in artificial intelligence and biogenomics. That diversity compliance early on is additive if it's not too much bureaucracy. So that's the balance, and I'm always trying to find that balance.
I guess one of the advantages of sovereign wealth funds is they tend to write check sizes that are big enough that they can actually have quite an impact on the, the company makeup as well. They can have, they take board seats. PIF took a board seat in Uber.
Absolutely.
So they have the good fortune of being able to influence decisions probably more than a smaller investor would.
And all investors, all venture capitalists will talk about long-term. But we all know, truly there are long-term investors that are impatient with the quarterly and the annual goals. So it's not just step back, wait 4 or 5 years and see what happens. So it's that balance of intensity and impatience around quarter to quarter, year to year quality growth, and at the same time thinking through 5 to 7 to 10 years from now, what are we trying to accomplish? How do we build sustainability and defensibility to build enduring organizations and cultures?
I remember in one of my first meetings with Mubadala, the Sovereign Wealth Fund in Abu Dhabi, and they were talking about having a quarterly perspective, and they actually meant 25 years, which was such a shock to all the private equity or the equity people in the room, because obviously for them it's 3 months. So it's definitely a divergence in terms of time frame there. So maybe just to finish off, we've just got 1.5 minutes left. Where do you see the greatest opportunities at the moment in terms of sectors and locations in emerging markets?
Well, I'd probably point to 2 areas. One, as I've spoken about in India, we still see India as probably the premier destination in emerging markets. If you're looking as a long-term investor, that is where we've had some of our sovereign wealth fund clients invest in specifically, is in India. The other area that's really been quite remarkable is, we recently had a team come back from China. We're in China quite frequently, multiple times every year, really scouring the universe, going through the A-share market, and our firm has been very experienced biotech investors on the public side in the U.S., and their comment coming back was that the healthcare and the biotech area in China is really very, very attractive, very strong pipelines, very well-developed companies, very forward-thinking companies, and so it's something that maybe wouldn't necessarily resonate with people, I think, from a stereotypical perspective, but is far beyond that.
I would simply summarize it by saying the Bay Area still in San Francisco, despite the housing costs, transportation is absolutely going to remain a center of innovation. But the Bay Area of southern China, Zhuhai, with all the transportation infrastructure, Shenzhen, Guangzhou, that is going to be, whether it's biotechnology, information technology, advanced manufacturing, that specific area of China, I would go very long for the next 10 years. Again, find the best entrepreneurs, start with the basics, but as a market opportunity, southern China and the Bay Area that's emerging in southern China, I think will yield phenomenal long-term returns.
I'll keep mine short. U.S. real estate, very popular now with the tax reform. China, U.S. private equity, venture capital, very attractive, and always infrastructure. Yeah.
Excellent. Well, we have run out of time, so I'd like to thank the audience for listening, and thank you for your participation as well. Learned a lot, and I think that sovereign wealth funds definitely have a huge role to play in the emerging markets going forward. So thank you all for your attention.
Thank you.
Thank you.